Then we have the accrual versus cash. Now, this is one that people often get confused and have questions about, noting that accrual is the default. So as a general rule, you want to keep it on accrual unless you have some reason to put it on something other than accrual. And you might say, well, hey, I want to be on a cash-based system. You might be on a cash-based system based on, the type of industry you're in, even though this is selected an accrual basis. So let me show you what I mean over here, because again, a lot of people will have questions about this, and it'll come up for taxes as well, because you might say, hey, look, I've chosen to be a Schedule C on a cash-based system on taxes, so maybe I should toggle this to a cash-based system. So let me give you the idea. I'm going to go to the flow chart over here, noting this is the desktop flow chart, even though we're using QuickBooks Online, because we're just looking at the flow of the forms, which will be the same in any kind of accounting system. So when I say I'm on a cash-based system or I'm on an accrual-based system, note that there are some accounting systems where you can say you're on a cash or accrual and there won't be a difference in the reporting on a cash versus an accrual, because there will only be a difference when there's a difference between when the revenue was earned or the expenses were incurred and when you paid cash for the expenses or received cash for the revenue. So one way we can look at it is to say there's no difference between a cash basis and an accrual basis unless there's a disparity, a difference in the timing of when we earned revenue or when we incurred expenses and when we received the money for the revenue earned and paid the money for the expenses. So they'll be the same. But from a practical standpoint, most people see it as when there's a difference. When that difference happens, that's when we're on an accrual basis. In other words, you'll basically say you're on a cash-based system if you have a simplified accounting system where you receive money at the same point in time you do the work and you pay the money at the same time that you incur the expense, even though it's the same thing. Accrual or cash would be the same thing in that instance. And you're on an accrual system in those instances when there's a difference, because it forces you to be on an accrual system. Let me show you what I mean. Let's say we're on the revenue side of things, and let's say that like you're at a cash register, for example, or let's say you're in a gig work situation. If you're in gig work, you're going to get paid during the same month that you did the work by YouTube, or say let's for the AdSense revenue, and you might record it, say with a deposit form. When you get the deposit form, you're going to increase cash at that point in time, and you're going to increase revenue at that point in time. And you could say basically you're on a cash-based system. You're recording it as you receive the cash, possibly with the use of the bank feeds. That makes sense. But you could say, hey, look, I'm also on an accrual-based system, because from the accrual standpoint, I should record the revenue at that same point when I got the cash, not because it's when I got the cash, because it's when I did the work. I did the YouTube stuff and I put it out there or whatever, right? If Google's paying me, or I did the AdSense and so they paid me. So I should be paid at that point in time on an accrual basis because it's when I did the work. I should record the revenue at that point in time on a cash-based system because it's when I received the cash. So it's going to be recording revenue at the same point, whether you call it an accrual or cash-based system, because the receiving of the cash and the earning of the revenue happened at the same point in time. However, let's imagine that you are in an industry where you have to do the work first, and then you invoice the client, meaning you have to track accounts receivable. Well, that's driven by the industry. You're forced to do that. If I'm in a law firm, if I'm in a CPA firm, if I'm a landscaper, that's just the way the industry is basically generally set up. So I'm kind of forced to have this disparity of when I'm going to collect the money, which is after I did the work, and then when I did the work, which is before I collect the money, and the invoice is going to be the form that records the increase in the accounts receivable. So most of the time we would think now you're on an accrual-based system, at least for this part of the revenue cycle, because I have to do this non-cash transaction. I've got to increase accounts receivable and record the revenue at that point in time when I did the work. So notice that forces me to be on a cash-based system just on the industry that on an accrual-based system just because of the industry I'm in and because now I have to track then the accounts receivable. If I forced myself to be on a cash-based system, even though I have to track the accounts receivable, that's when that toggle is going to cause something to happen on the form. So similarly, on the vendor side of things, most small businesses are going to pay the bills as they become due, either with a check or expense form that might come through the bank feeds or with a credit card payment. And therefore, basically, we would say they're on a cash-based system. But you can also say they're on an accrual-based system. It's just that they're paying for the thing at the same point in time that they incurred the expense. It's only when they enter the bill that they're forced to do an accrual thing. Now, there's a difference between the point in time that you incur the expense and when you're going to pay the expense, and you have to deal with that accrual component of accounts payable. So what that means over here for reporting purposes is that you don't need to toggle this to a cash-based system if you're on a simplified system. If, for example, you are recording all of your transactions with deposit forms as they clear the bank account and recording revenue when that happens, and you're recording your expenses with expense type forms as they clear the bank account with bank feeds, then you're on, in essence, a cash-based system because you're paying for things and receiving things, the money at the same point in time you earned the revenue and at the same point in time you incurred the expense. So it shouldn't, in that case, do anything. There won't be any difference if you toggle this from a accrual to a cash-based system because you're in a simplified system that doesn't have a timing difference between when you receive money and when you pay money, when you earn the revenue, and when you incur the expense. But if there is a difference, that means you're going to have accounts receivable here, for example, and you want to track accounts receivable. You're forced to do that. So the only time this would make sense is basically if you're saying, hey, look, I have an accrual thing that I did, like accounts receivable, and I would like to transfer this as though I was on a cash-based system, even though I have this accrual component. What would happen then? Well, then the accounts receivable is representing the revenue that was earned, even though cash was not received. It's going to reverse those. It's not going to record revenue at the point in time you enter the invoice, but it's going to record revenue at the point in time you received the payment. So therefore, this accounts receivable should go away in essence if I toggle this to a cash-based system, right? So now accounts receivable is gone. So that's when you might use this. Now note, what you're doing when you do that is kind of like you're switching to basically a cash flow basis, which is kind of what the statement of cash flows does. So you will recall that we have the two major financial statement reports, balance sheet, income statement, or profit and loss, and then the statement of cash flows. So that's an attempt to try to get the best of both worlds of having an accrual system, which is typically better for comparative performance purposes, particularly on the income statement, and then also be able to convert that to a cash flow system so that you still have the cash flow component. So in essence, what you're doing when you toggle the income statement, for example, to a cash-based system is you're kind of making a cash flow statement in essence, right? Which you already have kind of a cash flow statement if you, at least in an indirect method. So that's kind of the idea. So the basic idea is you usually want this on an accrual system, even if you have a simplified system that's basically equivalent to cash. So if you're thinking you need to switch that to a cash system, check with your accountant and whatnot, because typically it's not the case. All right.